we do this 50-year mortgage for only $700 more per month, we could finally stop renting this place and start owning it.
50 years, we're 40. We'll be dead by the time it's paid off.
Our grandkids will pay it off. Plus, it gives us the biggest advantage to being homeowners.
What's that?
Telling people we're homeowners.
That seems worse than renting. It seems like it just benefits the banks and it's worse for the people.
Come on. When in history have the banks put the whole housing market at risk for a few short-term bonuses?
50. I'm already laughing. 50-year mortgages. 50-year mortgages. I got the notes. You know what that means. If you haven't heard the news, they are talking about bringing back the 50-year mortgage. Now, it sounds like it's affordability. It sounds like it is a solution. But lower monthly payments does not equal a cheaper, more affordable home. We're going to look at the numbers. We're going to get past the fluff and the puff. We're going to find out why 9 out of 10 people should avoid the 50-year mortgage like it is the black plague on steroids. You need to avoid 50-year mortgage like it is the end of the world, like it is the apocalypse, meaning that you need to do everything you can do to prepare yourself to make it through the apocalypse or avoid it at all costs. Because this is, oh my God. What I noticed is this is the same thing they're doing with cars, or what they're doing with cars. They get you with that lower payment you want. Where you want your payments to be? You ever want to go buy a car? What they tell you? Where do you want your payments to be? Or I want my payments to be here. They're going to get you at that payment, but it may cost you some money. Okay, we can get you at that $350. We can get you at that $450. How much money you got down? Okay, we're gonna make it work. Not realizing they're gonna bust your head on the back end, pun intended, with this fee, that fee. They're gonna charge you more interest. They're gonna jack the price of the vehicle up, all because you want to be at a certain payment, but you paid more money in the long run. But hey, you got what you wanted.
The reason that salesmen ask customers where they're trying to be monthly payment wise.
Wrong. Goat. Sorry, bub. You're absolutely wrong. As the owner of a car dealership, the guy who signs the front of the check, name is on the building. There is only one reason why a car salesman will ask you what your monthly payment budget is. That's strictly to get ammo so that they can use this against you down the road and to pencil their deal correctly. As a consumer, when you tell a car salesman that you want $400 a month, the salesman automatically knows that they can get you to go higher. If you give a ridiculous number of like $250, $200, $300 a month, they know you're just playing games and they're going to play 10 times the amount of games with you and they're going to win. So when a car salesman asks you what you want your monthly payment to be, you tell them this: hey, I don't know. I don't know if I'm paying cash or I'm going to pay monthlies. I don't know if I'm going to do financing outside of the dealership. I'm not too sure. I'm only interested in what you guys are willing to sell the car for.
This is basically the same thing. Basically the same thing. So before you sign away decades of your life, we need to look at the real cost. I realize that most people don't look at the real cost. They look at the payment, but they don't look at the overall cost of what something is going to cost you. How much is that vehicle costing me overall? Not just, oh, the vehicle is $20,000, I can afford that. What about the interest? So you just don't count the interest, which makes no sense, because if you look at the interest, you're like, nah, I might not want to do that. So what we're going to do is we're going to break down the numbers for what they truly are, not what they look like. Now, the current 30-year rate is around 6.22. These are all estimates. I know it can vary. Just stay with me. The current 30-year rate is around 6.22%. A 50-year term would likely be around 6.5. Why? The longer term equals more lender risk, so you have a slightly higher rate. Of course, it's going to vary according to the person. These are just baseline numbers. Again, our current 30-year rate is around 6.22%, With the 50-year term, the average or whatnot is probably going to be around starting at 6.5. Why? Because a longer loan equals more lender risk, so you have a slightly higher rate. The monthly payment goes down, but the lifetime cost goes way, 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 way up. And when I say way, way up, jeez. So let's look at what this means in real dollars, because you work for your money. Maybe you got an inheritance, whatever. It's your money. The first thing we're going to do, we're going to use a $250,000 home example. Then we're going to work our way up. So at 6.5%, that's the base scenario. That's your interest rate. 30-year loan on that is going to be $1,580 on the $250. $50. I wish it was $50, right? A $250,000 home loan at 6.5%, 30 years, you're going to pay $1,580 a month. Again, these are just baseline numbers. On a 40-year loan, that same $250K house, you're going to pay $1,464 a month. So you see, it goes down. On a 45-year loan, you will pay $1,432 a month. On a 50-year loan, just showing you, on the 50-year loan, you will pay $1,409. Now, the difference between that 30-year loan and the 50-year loan is about $171. You may say, well, I could use that $171. That's not too bad. Give me the 50 because I'm paying less monthly. I'm paying $171 less monthly. So give me the 50-year loan. Okay, you want that 50-year loan? Let's break it down. So we got 30, we got 40, we got 45, and we got 50 on a $250K home. Y'all with me? Now, on a 30-year mortgage, the total paid on the house. Now, you bought a house for $250,000. The total you pay with interest is 500. Say what? No, you can't be 5. No, it's 5. $568,861 on a 30-year mortgage. They are getting a house and then some out of you. This is why I told you my last video when we talked about the cost of home ownership and should you buy, should you rent. If you're going to sign up for a 30-year mortgage, you need to pay it off in 25, 20, if you can, half that time. I'll say that one more time. On a 30-year mortgage on a house that costs $250K, the total amount you're paying, this is just baseline estimates, $568,861. Of that, $318,861 is interest. So you're thinking 6.5. Nah, it's 6.5 times and times and times. Because you're looking at just a 6.5, but you have to look at the total interest rate you're paying across your, see if I can say it right, amortization, probably said it wrong, table. What about 40 years? If you do a 40-year mortgage, I know that's uncommon, but if you do a 40-year mortgage, the total pay is $702,548. Of that, $452,548 is interest. 45-year is $773,065. Of that, $523,065 is interest. What about the 50-year? Remember, this is on a $250,000 house. Most people, they're not going to go for a $250,000 house because of their pride. I don't want that. I want this. Okay, you can have it. The bank is going to give it to you. They're going to take you through the ringer. The reason they take you through the ringer and make it so hard is not because it's that hard to get you into a house and they have to check all these records and all this and all that. Is the emotional part of it. Because, once they got you to that point, you just like, I'm ready to sign literally my life away.
Having a mortgage is trash. Let me
Let's talk about why. In today's economy, a lot of people's mortgages are the death of them because of the rates, because of the payments, because people are losing their jobs. So let's go a little bit deeper. It seems to me like the American dream is becoming more and more like a nightmare, right? When you can no longer afford your mortgage, but you're in a 30-year term, what would you do? If refinancing would get you a higher rate than what you currently have, you can't go that route. You just lost your job. What are you going to do? I have a client who's currently in this situation. Her mortgage is a little less than $2,000. She makes great money. However, other things in her life are going haywire. Therefore, her mortgage has been on the back. How can I say this? Her mortgage has not been her priority to pay. I personally feel like if she was renting something versus getting a mortgage, she wouldn't be in this situation because of the rent prices in her area currently. What I'm saying is I want people to reevaluate their American dream. Really think about what comes with having a mortgage. Really think about what comes with renting an apartment. I'm at my mama's house now, y'all. We are officially out of mama's house. We are now paying rent. It's $2,000 a month. You cannot think in your right mind, in your wrong mind, that I did not prepare for this. People get mortgages and they do not prepare for the rainy days. You should have a substantial emergency savings account. You should not have any credit card debt. Yes, you need a roof over your head, but you don't need that particular roof. There are different housing options out here for y'all.
It's not that you get into a mortgage for 30 years, is that you have no exit strategy of how to pay this loan off faster. That's the problem, because you're getting into it having no understanding of what you're getting yourself into. So here you go. What about the 50-year amount? The total paid is $845,575. I'm going to say it one more time. If you do a 50-year mortgage on a home loan of $250,000, the total paid, if you took it to the 50 years, would be $845,575. And you know it's going to be higher than that because we haven't talked about maintenance and stuff like that. You're looking at probably close to $1 million. A $250,000 house. Now, of that money, $595,575. Oh my God. These folks done lost their mind. They finna get y'all. They ain't gonna get me. I humbled myself. I bought a house for $10,000. I bought a house for $10,000. It was raggedy, but I fixed it up. And now we don't owe too much on that house. We have nothing but straight up equity. Y'all might need to look into getting you a fixer upper. And you don't have to live into the fixer upper. Go back home. Like, what's wrong with that? We live in a society, especially black folks, as soon as you're 18, your ass getting out.
Now, I don't remember the name of the creator, but the other day I saw a video of a woman talking about the trauma of being kicked out of your house after turning 18. She said that after she turned 18, she was given about 30 days to get out of the house. And as a person that's been on their own since they were about 17, I could really relate to that video. Now, I never understood why parents do this. It's such a disservice to your child. You are putting them out in the world with no tools to survive, and you could be putting their lives in danger, and you're also setting them up for failure. My situation was a little bit different. Ironically, I didn't move out of the house. My mom moved out of the house. Yeah, you heard what I said. My senior year of high school, my mom moved out. She packed up her shit, she moved in with her man, and she pretty much just abandoned us. Now, this happened a really long time ago, so I can't remember all of the details, but I do know eventually the authorities got involved and they were like, yeah, this is not appropriate behavior for a mother, and she lost custody of my siblings. I was already about to turn 18, so they said to me, you don't need to be involved in this, and I hope you have somewhere to go because shit is about to get real uncomfortable. My other siblings went to go live with family members and I was sent to go live with my dad, but that did not work out at all. I was a really damaged teenager and I had been through a lot. I needed intense therapy and I don't think my dad really understood that. Me and him argued all the time and he didn't have to tell me to get out. He made his house so uncomfortable, I practically ran out. So I gladly bought a one-way ticket and went back to Denver, and I lived with my boyfriend for about a year and then we broke up. So I moved back into the empty house. My mom did not mind me living in the house by myself, but she did ask me to give her my entire paycheck because it turns out she wasn't paying any of the utilities and she was behind on that and she wanted me to pay them if I wanted to live there. And I said, absolutely not. I'm going to save my money and I'm going to get my own shit. And that's exactly what I did. So now I'm 19. I have my own place. Everything's going well. But I still really needed a lot of guidance. And I just didn't have any adults in my life that I felt like I could trust and that I could go to. And this is where the bad decision making came in. Because when you're operating from a place of desperation, that little voice in your head that says, hey, maybe something isn't right, that voice gets quieter and quieter until you eventually don't have that anymore. One day I was at a Walmart and I got a bunch of stuff from my apartment. I was waiting at a bus stop and a pickup truck drove past me and asked me if I needed a ride home. And like an idiot, I got in the car. I had been told my entire life not to take rides from strangers. That is like the first lesson of life that you learn. I knew this to my core, but because I was so tired and just drained, I felt like I deserve a break, and I took a ride from a stranger, which was really not a smart thing to do. But again, I was 19 years old. Thank God he was kind. He said to me, you know what, I'm a father, I'm going to help you out, but please don't ever do this again. And that's when I realized I am truly too young to be doing all this. Like, I need an adult. I'm a child. I have no idea what I'm doing. I'm making really bad decisions, and that could have been the last decision I ever made. So I called my dad and I said, hey, things are not working out. I want to go to school. There's things that I want to do and I just can't do all of this on my own. And he said, of course, you can come back. We worked in our relationship and now we're actually really close. All I know is my kids will never go through that. They can always count on me. I did not have my children to abandon them. And no matter what they're going through, they can always call me. And they can also live in my house for as long as they need to. Things are so hard nowadays. Why put your kids out before they're ready? I just don't believe in that. And I hope that as a parent, when my kids are older, I can do better and I can give them better than what I was given. So they won't have to experience the things that I did.
Stay home. Stack your money. If you are of that age. And if you are not, go back home. Go back home and get your situation together. You could work out something with your parents. Hey, let me rent the basement. Let me rent the old room. You ain't got to stay there for free. But I guarantee you stand with your parents or relatives and y'all come into agreement that's beneficial for both parties. It's going to save money in your pocket and save money in their pocket. Now, of course, you got to do it with somebody that you're on good terms with. But guess what? I did that. We had a manufactured home we were renting. I think we paid about $650 and we were going to buy it. And bills just got too much. This is right before COVID. It just got too much, man. I'm the one that's bringing in the money. And I just got rid of everything. Now, I had thought about it. I told my mom, I was like, hey, if we needed to come into your backyard and rent it, could we do that? She said, yeah. So it was already planted. I made the decision to my wife, said, sell everything. Because I saw where it was going. I'm like, I'm not going to keep on doing this. I'm tired of pushing this back, pushing that back, pushing that. I'm just got tired of it. I had a drop top Camaro 22 IROC. That thing was clean. I worked to get that car. Wife had a brand new car. You know how it go. We sold everything, got rid of the cars, got cash cars. We had an RV at the time, ended up selling that later to my brother-in-law. But we had an RV that I inherited from my wife because she had it when she used to live in California. And we moved into my mother's backyard, living basically in our RV most of the time, but also my mother's house, taking showers and stuff like that. And I paid her rent. Started over from scratch, started a new business at the particular point in time, save my money up and everything, end up buying the piece of land that we end up selling when we moved here to Arkansas. But I bought the land without seeing it. Now my wife, she went and saw the land. I didn't see it. I did my research. I said, okay, boom, you seen it? Pull the trigger on it. Years later, when we moved here, I sold that land for a profit. Sometimes you got to do that, man. Y'all got to humble yourselves. Look where it got me. I humbled myself from having 2 cars repossessed to basically having 4 cars paid off. Is it the most luxurious cars? Is it this? Is the newest? No, it's not the newest. But they paid for it. They are paid for. The only one that's not paid for is the van, and I'm going to pay that off probably end of this year, going into next year. If I do get something else, finance, you guarantee I'm gonna finance it for about 5 years, but it'll be paid off within 2 years or half that time, because I have a strategy going into it before I do it. Now, when we got that van, we didn't have no, these folks don't know how to drive. They're like, they're gonna hit my car. When I got that van, I had no choice because I needed a vehicle right there for my family. So that was what it was. Now, going back to what we're talking about, payment barely drops with the 50-year mortgage. It's not like it's a lot of money, but the lifetime cost jumps by about $277,000. Interest doubles the longer you stretch the loan. And the first 15 or 20 years, you very slowly build equity because most of it's interest. This is no different than subprime lenders when it comes to cars. Like, isn't this the same thing that got them in trouble in 2008 when they were doing stuff like this, giving people houses that had no business getting houses? It seems like the same thing to me. I'm just saying. This is why long-term loans create the illusion of affordability. To me, this is nothing but another power and money grab as a result of pride and greed. Instead of fixing the problem, they will make the problem worse. And here's the crazy thing. The average age of a first-time home buyer in the U.S. is now around 40 years old.
40 years old. That's how old the average first-time home buyer is. Not 30, not 25, 40. According to Redfin's 2025 Housing Affordability Report, 84% of Gen Z just said they're putting off marriage, kids, and their careers. Not because they're not ready, because they literally can't afford a house. Median home price is about $407,000. You need to make $141,000 to afford it. Average Gen Z salary, $70,000. That's half. They're making half of what they need. First-time home buyers are down 50% since 2007. They're only 21% of the market now. And X is calling them the lockout generation. And posts are going absolutely crazy. So what's actually happening? Well, Gen Z is grinding side hustles, pulling money with friends, getting their parents to co-sign, whatever it takes. And entry-level home sales right now are practically frozen. Well, frozen in most areas in the South, Florida, Texas, and so forth. Not so much in the Northeast. But rentals and fixer-uppers, they're on fire. Multifamily investments are jumping 7 to 10% yields. Now, Gen Z isn't quitting. They're just rewriting the game, and the market's about to feel it. The move? Look at smaller markets. Fixer-uppers, or buy with a friend or relative. And in some cases, even get a manufactured home or mobile home. And real talk, unless affordability actually gets better, co-buying might be the only way most people can get into the game.
The average age of a person that's buying a house in America as of right now in 2025, going into 2026, is 40 years old. I mean, I ain't the smartest guy in the world, but 40 plus 50 is, you're dead. You basically dead, 90 years old. Come on now. I ain't saying there ain't no people getting around good 90 years old, but 90 years old, you already know what's up. Who wants to do that? I don't believe they're necessarily targeting 40-year-olds as first-time home buyer. I believe they're targeting, if you want a house, come get a house, because we know most likely you're going to default on that, and then we're going to get that money back because we're going to get the house. We're going to make double or triple off of you. You're going to default. The loan is front-loaded, so we're going to make all our money in the front on the interest. Now, the reality is most people are not going to go for a home that's $250,000. That's the reality. The average home price, this is just an estimate, I know it varies, is about $420K. You can see where we're going. If that was the numbers with a $250,000 house, what are the numbers going to be with a house that is $420,000? That's what we're going to use for an example. We're going with a 6.5 interest rate on a house that's $420K, 30-year loan. Your mortgage payment is going to be $2,653. On a 50-year loan, your mortgage payment is going to be $2,363. So that's a monthly difference of $290. You're like, I need that $290. Okay. It's almost like, do you know what mortgage means? Mortgage means death pledge. Now, they make an argument saying, well, it's not really a death pledge in the sense of we want you to die. It's a death pledge because it's dead. I don't buy that. But it's almost like they want to live up to the name of what mortgage means, which means a death pledge, a dead pledge. It's almost like they want you to die before you pay the pledge off. It's almost like they want to suck the life out of you until you die because now you're stuck. If you try to sell it, you ain't gonna walk away with no money. It's almost like they really want to fulfill that name of death pledge. Now, on a 30-year loan on a $420K house, the total paid is $955,260. But y'all not looking at the whole numbers. I got me a $500,000 house. How much is it really costing you? The interest that you're paying on a 30-year loan on a house that's $420K, what is the interest you're paying? $535,260. That's what you're paying. What about on a 50-year loan? I don't think you want to finish the video. You don't even want me to finish the video, do you? Because you don't want to hear these numbers. But since we're here, let's go ahead and get it. On a 50-year loan, the total amount paid is $1,417,800. I want to cry. Oh my God, I want to cry. My house ain't that big, y'all. It's a little bit over 1,000 square feet. But I will take my house that I got over this any day. Because I can always add on or build on to my house. This right here is... What about the interest? You're buying a house that's $420K. What is the interest on that house over the time period of 50 years that you're paying of that $1.4 million? $997,800 of that is interest. A $420K home becomes $1.4 million on a 50-year term. And you pay almost a million in interest. But the house ain't worth $1 million. Most likely you're not even going to live to pay that house off. That's the crazy thing. You're going to die, you're going to lose, and they're going to put somebody else in there on the 50-year term. That, man, you talk about evil. That is evil. That shows you how bad it is. When they're doing stuff like this, they just greedy and evil, and it's just bad all the way around. It ain't bad for them because they still got money, but they want to make more money.
I can't afford that payment. Is there any way you can put more money down? I can barely do the 5%. Right. If it wasn't for all these companies buying up houses and driving up prices, then us homebuyers wouldn't have to compete with corporations that turn thousands of homes into rental homes. Excuse me, I think I can help you with your problem. How? We're now offering a 50-year mortgage. Since when? Which means your payment would drop about $200. But over the 50 years, the customer would pay an extra $500,000 in interest. You'd be in debt your whole life. I think you're onto something. Really? Yeah, but instead of 50, can we do a 100-year mortgage? What? That would drop my payment even more, right? Let me calculate that real quick. You can't be serious, are you? That would drop your payment an extra $100. So you'd be paying $2,000 a month. And we'd be getting paid $2 million in interest. That's still too high. Thank you guys anyway, though. Wait, what if we did a multi-generational 500-year loan? Your payment would be $950, and we would be getting paid $5,300,000 in interest. We are not gonna be here. Deal. Now I know how my parents felt to have a mortgage payment under $1,000.
You save $290 a month, but spend $462,000 extra over time because you want lower payments. They do the same thing with cars, man. So this is why the 50-year loans don't solve affordability. They hide it. Now, there's something called the 30% rule in regards to affordability. You can go look this up. The 30% rule is the basic idea that your housing should never eat up more than 30% of your income. A lot of you know this because you want to go buy a house and they say, oh, 30%, this and that, even when it comes to a car. 30%, 28%, they want you to be at a certain point, your debt to income, stuff like that.
You're not supposed to spend more than 30% of your gross income on housing. This has been financial advice for many, many decades, and it is very smart.
So why do they have a 30% rule? Because once your rent or mortgage crosses that line, your budget starts to suffocate. Think of your income like a pizza. 30% is 3 slices. That's all your housing is supposed to take. The other 7 slices cover everything else: food, gas, insurance, emergencies, kids, car repairs, and just life in general. If your housing takes 4, 5, or 6 slices, you don't have enough left to live without stress. So that's basically why the rule exists. It's a safety line to keep you from drowning in bills, but we know how they do. Okay, we're going to do the 30%, and then we're going to jack everything up, and then we ain't going to pay them more money. Crazy. Housing is supposed to be affordable enough that you can still breathe, still save money, and still live. Here's where it gets even crazier with what we currently are dealing with, 30 year and everything like that. The median household income is about $74,580. So that puts you at a monthly income of $6,215 a month. Now with the 30% rule limit, you can spend $1,864 a month all in on your mortgage. But you have taxes and insurance. The average property taxes is between $300 and $400 a month. That's the average, y'all. Come on, like, stop. I understand it's gonna be higher or lower. Like, use some common sense. The average insurance is about between $100 and $150 a month. And then you have what you're left for your mortgage, your principal and interest. Once you take that away, is really $1,414 a month, according to the 30% rule, that you can, according to what they put forth, afford to pay and live comfortably, save money, all these different things. Now, the question is, what home price actually fits $1,414 a month at a 6.5 interest rate? It could be higher, it could be lower. That is just a baseline that we're using. The affordable mortgage amount based on that would be $220,000, between $220,000, excuse me, between $220 and $225,000, based on the numbers. Now, you also have your minimum down payment. So that, depending on what your minimum down payment is, depending on what you're putting down, your affordable home price, based on what people are making and based on the 30% rule, that will put you between 200 and 235K based on what people make today. That's the reality. What does that mean? The real affordable price of homes as of right now is between, again, 200 and 235K. The actual average price of homes today is 420K. Homes are effectively 80 to 110% overpriced relative to income. That's as of today. People are basically paying, when you go get a house for 420K, you're basically paying double what the house is actually worth. That same house that's 420K should really be 210 if you split it, because of what the income is. And we know these houses ain't really worth that. We gotta pay it. Of course we gotta pay it, but we know what these houses are really worth, and it ain't no 420K. That shows us that the 50-year mortgage does not fix this. It just stretches a bad deal even further. For the average American to meet the 30% rule, home prices would need to be around 200 to 235K, not 420K. And that's of right now. The 50-year mortgage doesn't make homes cheaper. It just makes expensive homes look affordable. It's a trap. Lower payments make the loan look affordable, but it locks you into a half-century debt cycle. It is the slowest equity buildup of any mortgage. So it's not meant for you to get equity and use that equity if you know what you're doing. And the crazy thing is, if the market cools, you risk being underwater for years. And to me, you will already be underwater. Banks win because of interest. You lose because of time. I'll say it one more time. Banks win because of interest. You lose because of time. And how do banks make they money, class?
Did you know that average bank is making 3 times of what the total amount of your loan is on your house? Let me explain how. Studies show that the average person has a mortgage for about $200,000 on average. That's close to almost $250,000 alone. But what you don't know is that the banks are making up to $800,000 by the time that you actually get to that 30-year loan marker. Here's how they do it. Okay, so you have to first understand how your monthly payments are broken up. Your monthly payments are broken up into 3 different sections. Your first section is your escrow. Now, your escrow account is essentially the bank creating an account to pay for your property taxes. The second portion of your monthly payment is your principal balance. This is the amount that you actually pay to pay down on your loan. But the third portion is where they get you. The third portion of the loan is your interest. And the interest, I shouldn't even say it's your interest because it's their interest. Now, if you had to guess, say your monthly payment was $1,800, how much do you think is actually going to the principal balance, meaning the balance that's paying off your loan? Now, it depends on your interest rate, but let's just assume that, like I said, your monthly payment is about $1,800. Realistically, probably about $600 is only going to your monthly balance. And majority of that is going towards interest. If you calculate this over a 30-year period, because that's typically how long most people take out their loan for their house is, you'll see that if you calculate the monthly payments, banks are usually making triple the amount of what the loan balance is. This is what the banks don't want you to know. But The information's right in your face.
They make money by lending money. They make money by lending money and making money off of the spread, off of the interest, off of the difference. So you see what this is about. This ain't about you. It's not about helping you. Now, I would only consider a 50-year loan as a temporary tool, not a forever loan. So what I mean by that is you can do a 50-year loan, but you better have a plan to pay it off in 20 years. You better have a strategy to pay that house off fast. Let's say you're going to get let's say it's a mini mansion. The house is worth 1 point something million. Okay, I'm going to do a 50-year because I've run the numbers. I know most likely this house may be worth this amount of money. But even then, you still want to pay that house off. If it's a 50-year, I would shoot for paying it off in 30 years because you're still going to save money. Because there's also some things going on when they're talking about the credit score ain't going to be the same in regards to being able to get these houses. Of course, the income is still going to be there. So let's say you don't have the best credit, but you got the money and you're able to get this expensive house in this nice neighborhood. You can come up with a plan where, okay, I got the 50-year mortgage I'm going to sign up for, but I'm going to pay it off in 30 years. You see what I'm saying? So you knocked off 20 years. Now you got this house that's worth XYZ. You want to have a strategy before you even enter into it. So this can be a tool if you know what you're doing. It can be a powerful tool. Anything is a tool. Credit is a tool if you know what you're doing, but most people don't know what they're doing when it comes to credit. And a lot of us, we learn the hard way. Let's say you do the 50-year loan, you can refinance down when income or market conditions improve. Also, what I suggest is buy below your means for safety. You can do a 50-year loan on a house that's a investment property. The house could be $100,000, $150,000. They're trying to get out of it and need a little work. You can do a 50-year loan and then put money into it and pay over time because you know you can afford it. That's another thing to do. I didn't do the numbers on that, but let's say you get a house for $150,000 and your payments are what, $800. You know you can afford that. You know you can afford $1,600 or whatever. But you go get this house that's this amount of money. Now you doubling up. You use the 50-year mortgage to get lower payments, but you're paying more money on it to pay it off faster. It's another thing you can do. Also, add anything extra to a principal. Even $25 a month helps. That's with anything. When it comes to your car payment, don't pay what they want you to pay. Pay an extra 10, pay an extra 15, I'm telling you, before you know, you be like, oh, snap. Dang, my car paid off already, or I'm paying it off earlier than what I thought. They don't want you to do this. Why? The longer you stretch it out and you make those payments according to how they tell you to make it, they make more money off of you. Focus on ownership, not payment manipulation, because that's basically what this is. And remember, banks want interest. You want ownership. And it's kind of hard for you to have ownership when you have all this interest and then you end up falling on hard times and now you pay all this money and then you can't finish your payments. Banks want interest. We want ownership. A 50-year mortgage does not solve the affordability problem. It puts more money in their pocket. It simply stretches the debt. Do not finance your freedom away. Because a lot of you are already financing your freedom away with the 30-year mortgage. I'm not saying that you shouldn't have a mortgage, but you need to have a strategy. Even if you do have a 30-year mortgage right now, you need to be coming up with a strategy to pay that thing off faster. I just gave you the numbers on a $420,000 house, how much you really pay. Matter of fact, go look at your contract and see how much you really pay. Go run the numbers. And if you run the numbers, you can be like, yeah, we need to make some changes. We need to make some changes. They do the same thing with cars. Another strategy you could do is do what we did. There are plenty of opportunities. This notion that there aren't any good deals is bull jive. There is always a deal to be had. You may have to get creative. You may have to do some research. You may have to, get a house that you may not want right then. but you can make it into the house that you want. It could be a smaller house, and you could put the same amount of money that you spend on that bigger house. You could save up and then do an addition on that smaller house. I'm just saying. I'm a living example. You don't have to go that way. We paid $10,000 for our house. We paid extra $2,500 for the land next to it. So we're in it for $12,500 base. And then we did our renovations, our new electrical, brand new plumbing, brand new everything. Everything in that house is brand new. It's old now because we've been there for a while. But when I redid it, it was brand new. It cost me some money, but I love the situation. I love the position I am in right now because this is ridiculous. Matter of fact, good Lord. If y'all could see what's going on in the traffic, these folks, it's crazy. I just got a money order for, if I can see that, $300. $300. It was $302.55 from the post office. And this is going toward my mortgage. My mortgage payment, if you want to call it that, is only $225, but I'm paying $300. Why? Because any little bit helps that I pay extra to pay it off faster and own the property, own the house, own it all free and clear. Like, y'all, don't let these folks, don't. And if you do, you better have a plan. It's gonna be people that don't listen, and they're gonna be crying in a few years. If you do it, get you a cheaper house. Come up with a strategy before you even get into it. I mean, I'm gonna look into it because if I can use it to my advantage, then to get another property, hey, I'm just saying. What I'm not going to do is I'm not going to wait 50 years to pay that house off. Oh no. But get in the comment section. Tell me what y'all think. Tell me what y'all think about the numbers that I gave. Did y'all know that? Did you know that even with the house that you buy now for $420K, you pay that amount of money in interest? Did y'all know that? Did you know that about your own house? Get in the comment section and let me know. Share this video. Y'all know what to do. Y'all have a blessed one. I'm out.